Hello and welcome to Gold and Silver Assets. I'm Diora and it's Sunday the 22nd of August 2021. How are the big players positioned when it comes to gold and silver? As far as the futures market is concerned, we often hear how the commitment of traders reports tell us what the smart money is doing. But is that the case, and how may the COT reports be used as an indicator? Let's take a closer look at this. The COT report provides a breakdown of the open interest for futures and options on the futures markets. The data is collected by the CFTC at the end of trading on Tuesday each week, and they release the data to the public a few days later. So that's on Friday at 3:30 p.m. Eastern Time. Why the gap? Well, apparently it takes a few days to correct and verify the data before they release it. As we all know, the futures price is what sets the physical spot price of precious metals. People look at the COT reports to assess positioning in the futures markets. The participants in the futures markets are classified into different types, and these are all self-reported. The aggregated report separates the participants into commercials and large speculators. They also provide a disaggregated report which separates them further into subcategories. So this includes producers and merchants, swap dealers, and managed money. Overall, the commercials use the futures markets to offset risk in the cash or spot market. And this is the group that's thought to be the most knowledgeable. In other words, the smart money. People therefore usually pay most attention to how the commercials are positioned. Interestingly, the CFTC website says that due to legal restraints, the CFTC does not publish information on how individual traders are classified in the COT reports. In terms of the general behaviour of each of the groups, speculators are usually the trend followers, and they increase their long positions as prices are rising. Speculators are nearly always long gold and silver. Interestingly, they're generally on the right side of the trade as well, but they do tend to be overextended at the peaks. The commercials are the opposite. They increase their short positions as prices rise, and they usually go against the market trend. You can find the raw commitment of traders' reports on the CFTC website, and this is what it looks like. As you can see, it's not the easiest of things to decipher. I find that the charted version is much easier to digest. So this is from barchart.com. The top half of this chart shows the spot price of gold over the last 20 years, and the lower half of the chart shows the commitment of traders. So the green line represents the large speculators and the red line is the commercials. The first thing that you'll notice is that the large speculators are pretty much always above zero. And that basically means that they are usually long. The times that they were slightly short was in the early 2000s. So back over here. And also in 2016, over here, just poke below there, and in 2018, so again, tiny bit just below zero. The exact opposite is true for the commercials. They were pretty much always short. Can we use this information to help us predict the direction of the gold price? Well, one way to assess this is to look at what happened at the peaks of troughs in terms of the positioning. So let's concentrate on the commercials in red and see what the the gold price has done when the commercials are at fewer than 100,000 contracts. So I've marked that by this dashed line here. So that comes up to 100k over there. Okay, so whenever this red line is fewer than 100,000 contracts, what has gold done? Well, if we start with 2018, so over here, then we can see that there was a local kind of trough in gold. That was a significant low there. And of course, the gold price subsequently went up substantially. What about the previous time? So we've got another time over here, over this block over here really, which represents this time scale here. And again, that was a very significant low in gold. And although the gold price went up a little bit here, it kind of went sideways for a good couple of years really. Okay, what about further back? So we've got another section here where the red is above this dashed line, and that corresponds with this price action here. And again, that is a kind of a localized low in gold there as well. But note that subsequently price actually dropped for a couple of years. So notice how we've got three different kind of effects here, and price did different things after each time. And so that tells me that when the commercials are at their very least short historically, that doesn't really tell you what subsequent price action will do. But it does, I guess, tell you that you're potentially at a localized low. What about when the commercials are at record high levels of shorts? Does that help us? Well, if we look back here in 2010, at that time, the commercials were at record level shorts there. And here you can see that despite that, prices went up and up for a good couple of years there. The next record high was here in 2016, and you can see, yeah, price went up a little bit, but this really didn't do that much. And then the next time the commercials were record short was here in 2020, early in 2020, which was about here. And you can see price still went up after that while the shorts were decreasing. So overall, we can see that the positioning doesn't really seem to give us a hugely reliable signal. What about for silver? Well, silver's even messier. Again, the speculators are usually long, as you can see by the green line at the bottom there. But in 2018 and 29, they actually dipped into net short territory. So here you can see this dip below zero. Actually, the speculators turned out to be wrong at those times because the silver price basically went sideways that whole time. And interestingly, when we got this big sharp drop over here last year, you can see that the speculators were actually rather long. Ouch. Now, in contrast, the commercials have pretty much always been short silver. Again, except for 2018, they just about, over here, they just about dipped into positive territory there. But again, the silver price didn't do very much then either. When the commercials were at record short levels over here in 2016, I think that's the highest number of short contracts that there are, 2016 and 2017, you can see that, okay, yeah, silver price went up a little bit over there. It was actually sideways over there. And this bit here was a 25% drop in the silver price. When silver was at a major trough over here in 2009, And also when we had this major peak over here in 2011, you can see that the commercial contracts were actually kind of pretty average, actually, weren't they? Here and just around here, really. So it didn't really tell us that much about what the silver price was doing. Overall, I'm quite sceptical about how useful this is as an indicator, and I haven't been able to see any clear patterns. There are lots of derived indicators that people have developed over the years to try and interpret the commitment of traders. And so these include things like the COT index, spread and rate of change of the difference between commercials and large speculators, cycle analysis on the COT index adjusted for seasonality, and so on. I don't think that any of these work in a particularly consistent manner. Overall, I think that there are some pitfalls with using the COT reports. It's said to be a sentiment indicator, but I don't think it's a hugely reliable one, as we've seen. It's quite vague with no set benchmarks. So I don't think the actual number of contracts per se is particularly predictive of price action. A big problem is that the data is delayed by 3 days, so it's not going to be of any use predicting short-term moves. It's also not useful for timing, as there can often be a lag between sentiment and price change. Also, I think that it's not something that should really be used in isolation. So, in conclusion, from what I've seen, I'm not convinced that paper positioning of the so-called smart money is particularly predictive of price moves in the precious metals. It's also important to remember that paper positioning is not the same as physical positioning when it comes to gold and silver. So who is the smart money when it comes to physical positioning in gold and silver? Well, I would say it would be central banks and high net worth individuals. Next up, the market update. Well, all kinds of interesting things to discuss today. I thought we'll first start with the US dollar on the weekly scale. And we'd been talking, if you go on the monthly scale, this red line, which is a long-term resistance. And I'd also drawn this channel, but until this week, we hadn't had a touch of that. We haven't quite touched it. We're a few cents just below it, but we have touched this red line here as well. The question is, where do we go from here? And as with anything with charts, there are two ways of looking at it, in terms of direction anyway. And arguments can be made for either side. One way of looking at it would be, oh, this is a double bottom and we've just broken out above this here, in which case the target would be up in the high 90s here. But personally, I don't think that's going to happen. My view is that this is an important confluence of resistance here. We've got this down-sloping channel here, and this red line is a much longer-term resistance that we broke down from late last year. So we already rejected it actually this week. So, you know, the dollar index went up to that level, just slightly bounced off. That's why we've got this wick there. So, as I said, we are yet to touch this blue channel, but we're pretty much there, and it doesn't necessarily have to touch it. You know, none of these things are exact. But from here, I'm thinking that we're going to get a turnaround, and next stop 88 over here. let's watch that. Now, I think the US dollar is going to be quite an important factor in the precious metals and markets in general, of course. So if we break above this orange level and above this channel, then yeah, I think things will be very, very different. But let's see. I've got a feeling the US dollar is going to weaken from here. And this is just going back to one of our viewer suggestions who basically our viewer had noted that there's been a very strong correlation between silver and US dollar. So it's been a negative correlation. What I've done here, just to make it a bit more obvious, is I've inverted the scale for the US dollar index. So that's the bars here. And you can see the scale is inverted. And then I've overlaid on that the silver price. And that's the grey line here. And you can see they match pretty well. Ever since this low here, it's been a very, very close correlation for most of that time. And on the daily scale here, we've got the correlation coefficient at the bottom, which shows that the majority of the time we've had a very, very strong negative correlation. The most correlated you can get is -1 here. And it's, you know, again, it's getting pretty close to that. You can't get more correlated than that, really. Now, the first thing to mention is that this has not been the case historically. Often it doesn't correlate that well, and it's very up and down. But this has been so for quite some time. The question we've got to ask then is that correlation going to stay? If it does remain negatively correlated, then, and we think that the dollar has hit a turning point, as we mentioned in the last chart, then that would suggest silver may be close to a bottom as well. But and this is a big but, it depends if this negative correlation stays, okay? But look, we're a long way from it becoming positively correlated. So that's another thing to bear in mind. If we are as close as we think we are to that turning point, that would suggest that the same for silver at this stage. So I think in the coming weeks, looking at the US dollar index is going to be really, really important. Moving on to gold. This is in US dollars on the weekly scale. And here I've just removed all the lines. I do that occasionally just so you can get a clear, fresh look at this. And what we can see, we had this long grinding correction here. Price bounced up and then we came back down again. And this was quite a violent drop here. But we had a very, very long lower wick. And remember last week I said that if we got a green candle afterwards, that would give a little bit of hope. What we didn't want to see was a red candle. Now, can this dip back down? Absolutely. At the moment, it's uncertain. This candle here shows uncertainty, basically. And the other thing we want to watch out for, if we go above this trend line over here, certainly if we go let's say above 1820-ish, and of course definitely if we go above here, then we can be more hopeful, but we're not there yet. What you will also notice is that we've got this level here, which is kind of around 1680, which seems to be an important level as well, and we've bounced off that numerous times here. I think it's actually a good sign that we've got a long wick bouncing off of that. I'd be much more worried if we had a solid candle going to that level. I think that would increase the probability of breaking through there to the next support level, which would be around $1,600 there. So what we don't want is to have a retest of the 1680. I think if we retested that, there's a good chance, I think, that would break. But yeah, at the moment, let's see. I think I really do like this long wick here. So we just need to see a bit more follow through here in terms of this red candle. I mean, it may be that we move sideways a little bit here before breaking through upwards. Now, the other interesting thing is that if we look at other currencies, so this is gold in Australian dollars, and you can see that actually the chart looks quite different here. We've actually broken out to a new high over here compared to these two highs here. So we've got higher lows and higher highs. So that's interesting as well. And also, this trend line here joins this low and these lows here, and this one also confirmed recently. So that hasn't broken either yet. So that's all looking good. In terms of the Australian dollar gold price, then you will notice that we've got a lot of price action over here, and so I think getting above that 2,700 level in Australian dollars is going to be tricky. So again, it depends what happens with the currencies a lot as well. I mean, it may be that it's moved sideways before moving up, but I think we would hit a problem at this point here. Because also we've got this long wick and this new high. I think, again, that's hopeful. We could go sideways from here, but the way it's looking now, I'm not expecting a breach of this trend line here at this stage, but let's see. Then I thought we'd have another look at that parabolic kind of indicator idea that we've been talking about. And look, this is just an experiment. I don't know how well it's going to work, but it's always interesting just to try things and try them prospectively, because you get a very, very different view of things like that. Now, you'll remember that previously I'd actually marked the low back in March, which would have been about here. And it was a similar level to where we are now. What I've done is actually remove that now, because if you were doing it retrospectively, you'd have just picked the lows that, you know, and so you'd have ignored that low there. And so that's what I've done here. And so that's one lesson there, is that you can prematurely add data points without realizing it. But anyway, adding the data point from the 9th of August low, from which we've bounced back up from, we've still got a good fit of 9.891. So this is still on track. Okay, so where do we go from here? What are the potential low points going forwards that we need to watch out for? Well, this week we would have needed a close above 16.99, which we have. We're well above that. And so next week, we don't want it to go below 17.03. But let's watch, and we'll keep an eye on this. Now, you might ask, well, how did this work out in the past? And so this is one that I've looked at for the 2000s bull market. So the blue line marks the lows in the gold price. And you can see we've got quite a significant outlier here. That was the 2008 drop in gold there. And here we've got an R squared of 0.97 for the whole curve there. And what you'll also notice, it seems to become less and less accurate the further out you go. Okay. Moving on to the miners, and this is the GDX on the monthly scale. And yeah, it's been a rough month so far. Now remember, this candle hasn't finished yet. We've still got another week to go for that. But one of the things I thought was interesting about this chart is that looking at the volume. Now normally when you get this kind of curved shape, as we have here, so let's draw that in there. Normally that would kind of represent accumulation, and so you'd expect a kind of similar shape to the volume as well, but we've actually got the exact opposite of that. I don't really understand why that is, but anyway, it's interesting. The other thing is that throughout this whole price move here, volume has been dropping. And even though we've got a rough red looking candle here, the volume's actually pretty low. It's lower than average here, which is, I think, well, potentially a positive sign. But then I guess if everything's opposite, it might not be. Who knows? Yeah, I haven't been able to work out what's going on here with this. Okay, how much lower can we go? Well, we've got support. If you use the top of these candle bodies here, then we should be at support at around 30 here. And so we would really want to see a turnaround here. But yeah, look, it could go lower. Sometimes we could go deeper into this. So remember, often these support areas are usually ranges. So the next kind of lot of candle bodies is over here around 26, 27. And I remember on the daily scale, there is a tiny gap at that level around there. So, bear in mind, there is a potential for that to be filled. Whether it will or not, I don't know. At the moment, we haven't quite made a lower low. It's pretty close. I think it's like a fraction of I think it's a couple of cents or something away from reaching that low. But yeah, I just don't like the look of that candle. But look, anything can happen. I mean, you can have a big green and a big red candle next to each other as well. But yeah, look, there is support. I'm not expecting this to go down to 15 or 5 or anything like that. That's one of the problems with the miners, especially the silver miners, is the huge volatility. And having a 50% drop in your mining stocks is actually should be expected, and that's part of the reason why I'm just absolutely chicken about using leverage for these things. I wouldn't say that I'm good enough at this to take that kind of risk, and that's just me. But I am willing to sit through 50% corrections if need be, if the fundamentals support that. Okay, and then finally we have the silver junior miners. Now this chart looks a bit complicated. We'll go through it step by step. So yeah, again, we had a rough week. So a lot of down days in the past week with the silver miners. And what I've done here, so the first thing to look at is how far we've retraced the move from last year. Now I've made the move up to this point here. I mean, that is a bit of an anomaly. That was that silver squeeze move there. And so, I mean, you could argue, well, should you use that? Should you use this instead? And so, yeah, I mean, that can be argued a little bit. It's not going to make a huge difference in terms of the retracement, though. At the moment, we're getting close to that 50% retracement here. And we've got a lot of support over here. And we've got all this over here as well. We haven't quite hit it, though. And if we were to move this upper line up to here, then, of course, it would be even slightly lower, down to about here, I'd say. And so, potentially, it could drop down a little bit lower to that level. But price can turn around at 50% or the 61.8%. So those are the kind of two levels we ought to be looking at. So around the 12 mark, I would say. Now, the next thing to look at is I've drawn a moving average here. So this is the 200 day, is it, or 200 week? I can't remember now. Moving average, anyway. I think it's 200-day moving average. That's right. And at the bottom here, I've done the distance from the 200-day moving average. What you'll see here, of course, at this low in March last year, this reached just over 40% below that moving average. Okay, so that's pretty stretched down below. Where are we right now? We're around 20% over here. And what happened before then? Well, obviously the chart only goes back a few more years. It doesn't go back for 10 or 20 years or anything like that. But in the history of this chart, the lowest levels were about 30%. So this was a very, very out of the ordinary. This was the most stretched below it's ever been. And the other thing to note is that I've drawn these trend lines to join these lows here and of course the highs over here. And where are we now? We're pretty close. I mean, if you were to zoom in, we haven't quite touched that line there, but we're pretty close to touching that line. And so, I mean, so far, every time we've touched that line, we've bounced off of it. Will we do the same? And if so, look, that doesn't mean that this is going to necessarily shoot up and rocket up. What we need to watch for is a break of this line, I'm assuming. Well, we can look at that prospectively and see what that actually does. And if you remember my talk on asymmetry, we can look, what's the potential downside here? Now, I mean, yeah, we could get an anomaly like this a second time, but more likely we could get what's happened before, which is closer to 30%. So, I mean, we're already pretty close. We're at 20% now. So the downside would be down to about 30%, I'd say, max. But then, of course, that will break this kind of pattern over here. So I don't know. I'm just thinking that we're pretty close to the bottom here. We might get another little dip down, as I said, down to this 50% retracement, and that may be enough just to drop it to touch that trend line before we turn around there. But yeah, I just thought that was interesting. Obviously, the level we really want to aim for is to go up there. The other thing is, if we were, I didn't do it on this chart just because it's already busy enough, but if you were to draw a trend line over here, and you can also draw one with the I think with these highs here, you've got another one of those descending wedges here where price has gone like this and like this. So obviously these can fail, as we saw in silver. So yeah, it can drop out from below there. But yeah, it's just another observation there. Okay, and that's it for the charts for this week. I wanted to thank everyone who made suggestions last week. There were some really good, useful suggestions there. So I've made a note of all of them, actually. I found them very handy. And it's really useful to get some feedback on what you guys find useful as well. I thought that was great. So thanks everyone who did that. And, keep adding more suggestions as you come up with them, because we all want to benefit. I want you to benefit as much as I benefit from this as well. Another suggestion that we had a few weeks ago was someone was interested in news from over here, news from New Zealand. So this week we had some interesting news. So you may know that the New Zealand Reserve Bank, or it's a central bank of New Zealand basically, that's kind of been a trendsetter for central banks over the years. And in fact, it's called the RBNZ, Royal Bank of New Zealand. And in terms of trendsetter, they were the ones who started all this inflation targeting thing, which the Federal Reserve have taken on as well. And up until recently, of course, we've had increasing inflation figures here as well. And so there was a lot of talk about having to raise rates. And there was talk of raising rates by 0.25%. And it's getting pretty hard to justify not doing that. And the other thing that's happened, I think it was about a month ago, they stopped purchasing New Zealand treasuries. So basically, it was looking like they were going to tighten in the next meeting and increase interest rates. Now, of course, in New Zealand, we've got the biggest housing bubble in the world. And so a raise in rates would have been problematic. You know, there's a huge amount of mortgage debt out there. But yeah, anyway, they were all set to do that from what I heard anyway. But what happened I think it was less than 24 hours before their announcement of the rates, we had one of these turn up, if you know what I mean. Anyway, yeah, so we had one of these, and as a result, that changed everything, and some of the harshest restrictions in the world have been implemented here. And of course, that changed the decision. And so the rates remain the same here. Anyway, that's what's been going on here. Just a shout out to fellow New Zealanders. That's it from me for this week. All the best. See you next week. Bye.